Gold has broken over $4,000 an ounce, and $50 silver has broken the London over-the-counter market. In this gold market commentary for Friday, October 10th, 2025, we've got a lot to unpack. Hi, I'm Dana Samuelson, president of American Gold Exchange. If we can help you with any of your needs in the physical precious metals arena, we'd be honored to try and help you. So, in this gold market commentary, the relentless rally that we have seen in precious metals since August 26th may be finally getting a little top heavy and entering into a consolidation phase. When I go over the charts at the end of the video, we'll look at support levels. A silver squeeze has happened full on in London this week, which has broken the London over the counter market. Comex silver is in complete backwardization. And lease rates for silver and the exchange for physical premium. The difference between the price in New York and the price in London has exploded higher, indicating that there's an extreme squeeze on the need for physical silver in London, with premiums higher in London. We'll get into that in detail. We've seen physical demand for gold go global. We're also seeing Indian tariffs are fueling global precious metals demand. We're going to go over that a bit. President Trump's tariffs, or fear of tariffs, has caused gold and silver physical dislocations, and we still don't have clarification on whether silver will be tariffed or not, and that's creating further market dislocations. We'll talk about that in a minute as well. So let's get into our update. This is a story I picked up from Discovery Alert, a service I've never seen before on the internet, but the information here is quite good. And this is from about 3 weeks ago. London silver vault scarcity. Critical shortage threatens the markets. And that's exactly what happened this week. We attained critical mass on a shortage of physical silver in London, which drove the market crazy. Here's the setup. Estimates indicate that less than 150 million ounces of silver are freely available for purchase in London vaults, while approximately 250 million ounces trade daily in the market. This fundamental imbalance creates significant pressure on available supplies and underscores the severity of the situation. This isn't merely a temporary fluctuation, but represents a structural shift in how silver is distributed globally, with trading volumes regularly exceeding the total available inventory. The market operates on thin margins of physical backing, increasing vulnerability to supply disruptions. And that's exactly what happened. We saw demand overwhelm supply on Thursday, October 9th. Now, what's really helping to drive all this is the lack of clarification over tariffs, particularly those related to Section 232, that's silver potential tariffs, investigations under the Trump administration. This has led to a strategic migration of physical silver from London to U.S. markets. And unlike other precious metals such as platinum and palladium, silver lacks clear exemption pathways from potential tariffs, making it uniquely vulnerable to trade policy shifts. Previous silver market squeeze insights typically involved concentrated buying activity, where the current situation stems from a broader structural shift in where physical silver is being stored and traded. This makes the current shortage potentially more persistent and less amenable to a quick resolution. So specifically, this is what happened. We've seen demand ramp up for silver in particular, which is a much smaller dollar market than gold in terms of dollar volume, but it equals a whole lot more ounces percentage-wise relative to supplies. And the squeeze hit London full on overnight, Wednesday, October 8th, into Thursday morning, October 9th. Yesterday, as I tape this, today is Friday, October 10th. We saw the silver price break $50 an ounce in the spot market. And then we saw that pump up about $2 on momentum buying, which caused a complete frenzied buying in London, which created a lot of volatility. And some of this trading activity is on borrowed silver or leased silver. And as the situation escalated, the rates for the lease or the rent fee to borrow silver skyrocketed, and the premium for physical silver skyrocketed as well. So if you were borrowing silver several days ago, a week ago, or you had an unhedged position that was short, you were suddenly squeezed dramatically in your financing or through a lack of liquidity, which broke the market completely. And to explain this to you, we've seen the silver price differential in London blow out to as high as $1.80 an ounce over the New York price on Thursday, where it was just 40 cents a day or two before that. The lease rate for silver went from about 25% per year to 150% per year, which is 21 cents a day per ounce to finance silver. So that's a surge in the financing charges and a surge in the premium for physical silver. And all of a sudden, traders' positions went upside down and they were forced to sell. So we saw silver pop in the early day yesterday, Thursday, October 9th. And then a huge selling wave hit because suddenly traders had to just dump their positions to get back to whole, suffering significant losses in the process if they were unhedged or leveraged. And that helped to break this overall really strong precious metals rally that we've seen for 2 weeks, with metals rising concurrently in 7 or 8 of the last 10 trading sessions sharply. We finally got a correction on Thursday, October 9th, which was triggered by this London breakdown in liquidity in the London over-the-counter market. Now, today is Friday, October 10th. The situation's still pretty extreme. Today, the lease rate was quoted at 200% per year, which is 26 cents per day per ounce to finance silver. And the EFP, or the difference between the value of silver in New York versus London, increased to $2.25, which is what they're paying over the New York price in London to get their hands on physical silver. That shows you how big of a squeeze there's been on physical silver in London. And what this really means is we're going through a whole second episode, like we went through in April when President Trump ratcheted tariffs up on China to 145%, and the Chinese went on a massive gold buying spree, driving the gold price from 3,000 to 3,500. But it was more of a physically driven market than a paper or speculators driven market in the New York Comex exchange. This is the same thing that's just happened in London. And what both of these episodes really mean is the physical market for both gold and silver is starting to be overtake the futures paper market that has dominated markets for most of the time since the 1990s. So physical really matters. It's good and bad in that there was a complete dislocation in London, but it's good because it means you can't just print this stuff out of thin air like you can dollars when you need more of it. And that shows you how finite gold and silver are compared to the incredible amount of wealth that exists in the world today. And we're going through a reflationary phase right now where we've seen 30, 40 years of deflation in the price of things relative to the value of wealth. And now we're seeing a reflation in physical asset or things relative to wealth, simply because the world's realizing, hey, there's not quite enough of them to go around sometimes. And that's what this whole episode means. And this is why we're likely to see the silver price in particular go much higher still. Here's a chart that shows you just how sharply lease rates on the top for silver have spiked relative to where they've been over the last 4, 5, 6 years, which shows you how extreme things have gotten, particularly in London. So this brings me to how much gold and silver has been drawn into Comex warehouses over fears of tariffs of precious metals. This is a gold Comex warehouse chart that goes back to 1995. And it shows you two big spikes. One, when COVID hit, and there was a need for physical gold in the US that was sharp because demand for gold went through the roof. And then we sold that down, got to about 17 million ounces, and then we saw the Trump administration start to threaten tariffs and then finally put tariffs on April 2nd. And what happened? The inventories of gold in the US spiked to the highest levels we've ever seen, going from about 17 million ounces to a peak in April of 45 million ounces. Now, since gold has not been tariffed, we've seen about 5 million of those 45 million ounces of gold come out of the Comex warehouse since April passed and no new tariffs were announced on gold. Now, silver is a different story. If you look at the silver warehouse stocks, we had a similar run up in COVID and then a sell down, but then we went from about 300 million ounces to over 500 million ounces in April. But we don't have clarity yet on whether silver will actually be tariffed or not. That can was kicked down the road 180 days, and we're supposed to get resolution on that on October 19th. Is the day the Trump administration is supposed to announce whether silver will be indeed tariffed or not. And since April, we've seen about another 28 million ounces of silver come into New York Comex warehouses because the premium for silver has been higher here than it has been elsewhere. Now, if the Trump administration announces that tariffs on silver will occur on or after October 19th, this silver is not going to go anywhere. It's going to stay here. But if the Trump administration announces that there won't be importation tariffs on silver, we'll likely see some of this silver start to migrate back out to the rest of the world, in particular London right now, because that's where the need for physical silver is the most acute. But it's going to take time. Gold you can put on a plane and fly around the world. Silver has to travel on ships, and it takes weeks to move. So physical demand for precious metals has gone global. Been hearing stories and anecdotal evidence of buyers across the globe lining up at precious metals dealers' operations and buying out dealer inventories. And that's because this run up in metals over the last couple of months, primarily since August 26th, this sharp run higher has attracted global demand for physical products. And when this happens, the mints and the refineries cannot increase production quickly enough to meet these waves of demand. We saw something similar happen in the US between February and March of 2020. As we ended 2019, demand for gold was about 60, 70% of what it had been from 2014 to 2018. We didn't have a lot of demand for gold and silver. And then COVID hit and demand exploded. And there simply wasn't enough capacity at the refineries and mints to keep up with demand, which strained supplies. So that's what's going on around the globe right now. Not so much in the US, although that's starting to occur. But silver tariffs and tariff uncertainty can cut both ways. While we've got record Comex warehouse stocks for both gold and silver because of tariffs, what we're not seeing are new deliveries of products, primarily sovereign minted coins from mints around the world, Royal Canadian Mint, British Royal Mint, Austrian Mint, South African Mint, because they don't know if they send silver into the US of whether it will be tariffed or not. So that's making supplies here in the US a little bit less than they might normally be, which is now starting to create a little bit of a supply strain in the US as demand is starting to wrap up. And on top of that, U.S. refineries, in particular, have been backed up in processing incoming silver because so much silver has been sold into the refineries over the last 6 weeks or 2 months. When dealers buy silver over the counter, if they can't resell it, well, the ultimate buyer of last resort are refineries. So we buy it under melt and we sell it to the refineries for a little bit under melt. It takes a little bit of time to get processed. Well, so much of that has happened because once dealers' cash flow is absorbed, they've got to regain that cash flow. So they have to get rid of that metal one way or another. And the refineries are the buyer of last resort. So what we've seen are the refineries have had too much silver put into them, and some have actually stopped taking delivery of physical silver until they can process some of what they've already received, which is backed up. And really, the only product that's been in real demand here in the US for the last 3-4 months in physical silver are those big 1,000-ounce bars that refineries use for processing, that go into Comex warehouse vaults or other big vaults, or that go into ETFs, exchange traded fund warehouses. So physical demand has strained the marketplace in different ways. And a lot of the tariffs have created dislocations as well, as I've explained to you. And this brings me to what's happening globally. And I do think that India in particular is helping to fuel this precious rally more than we have appreciated. This is a chart that I showed you at our last update from Tavi Costa via X that shows Indian silver imports have been at record levels. I've had a few of my industrial strength trading friends tell me that there's a lot of demand in India for physical right now, both gold and silver. So I went looking on the internet and I found this on the Economic Times of India. And it says that gold ETFs in India have crossed the 10 billion on management mark on record investments in September. And regarding gold, not just silver, but gold here, so far this year, there's been $202.18 billion of inflows into gold ETFs in India. In 2024, that was 1.28 billion, less than about half of what they've imported in 2025. And that was 5 times the number of 2023 and 10 times the number of 2022. So in India alone, they're importing gold and inflows of gold into ETFs has been phenomenal. Well, last update, I also showed you a chart that showed how much gold had gone up and silver and other currencies. And while the dollar was the second biggest recipient for gold appreciation this year, the Indian rupee was the first. So if you're an Indian investor, gold and silver are a great way for you to keep your purchasing power. And they have a huge precious metals culture. In fact, on the Times of India website, they have gold rates that are quoted, silver rates that are quoted, and platinum rates that are quoted. And they also have a financial literacy section where you can learn more about financing, which my friend Robert Kiyosaki would love. Imagine if we had financial literary sections on US major financial web pages in the US. We don't. It's crazy. So let's look at the 1-year gold chart. You can see how much gold has gone up over the past year, 51% on a 12-month rolling basis, with a lot of those gains coming just in the last 2.5 months since Chairman Powell's August 26th Jackson Hole, Wyoming speech. Now, when I saw the dismal July jobs report, I guessed correctly that Chairman Powell would be forced to pivot from defending inflation to defending the employment sector in the US, and rates would come down. And I've been patting myself on the back over that. But as this precious metals rally has gathered steam, and we've seen a huge wave of global demand for precious metals, and not so much in the US, although the US investor is now participating much more than they have in the past. It started to bother me. I started to think I'm missing the picture here on something. And I think I found the answer. On August 28th, in response to India continuing to support Russian oil buying, President Trump introduced 50% tariffs on the importation of goods and services from India. And I think that this has had a much more beneficial effect on precious metals demand and pricing globally. It's similar to what happened with the Chinese in April when we ratcheted up tariffs on China to 145% when we were taking tariffs off of everybody else because China stood toe to toe with us, tit for tat on tariffs. And the Chinese alone, through physical buying, drove the gold price up from under 3,000 to about 3,500 in a few short weeks. I think these Indian tariffs of 50% by President Trump on India have had a much more meaningful effect than we realize in driving demand in India, which has helped to fuel precious metals prices higher, which has helped to fuel this whole global rally that we've seen, which has been incredible over the last 4 weeks in particular. And it matters because this is a global rally. And it's the physical market is starting to overtake the paper market for true price discovery of relative value. And if you look at silver, you'll see something similar. Silver's had a 57% 1-year gain, but it has literally skyrocketed since Chairman Powell's Jackson Hole speech and the Indian tariffs were enacted on August 26th and August 28th, respectively. I've gone back and looked at gold on the Comex exchange to January of 1970. You can see how gold has had this big long run up to 850, then sideways for 30 years that we ran up to 1900 in 2011, went into a consolidation phase up to 2070 at COVID time, sideways for 3 years, and then the breakout starting last year that has just been incredible. So while gold has doubled from 1,000 to 2,000 to 3,000 and now 4,000, silver continues to test its 2 previous all-time highs, this being a triple test of a top. And as one of my trading partners, thank you, Ralph, has said to me, a breakout above a triple top is often a very powerful move for any market. And for silver, we're right there right now. So I think silver has the potential to run another 10 or 20% pretty easily to $55 or $60 an ounce the way this whole market is set up. Let's look at the latest 6-month candlestick charts for some granular detail. Here's a 6-month candlestick chart for gold. And as I said, I think we could be getting into that spot where we go into a bit of a sideways move for a period of time after we've topped out with gold intraday hitting 40.59 on Wednesday, where the correction was that big red bar right to the right of that peak. That's yesterday's correction, and now we've had a little bit of firming. But if we do go into a correction, I see support for gold at 39.50, and then again at 38.25, and then finally at 37.25, where there's 3 green lines are drawn. Gold could actually drop all the way to 37.25 on a big correction, which I don't think is likely, and still be in a bull market. So it's very possible that we will test that first support level and we could break into the lower level if we do indeed go into a consolidation phase and a bit of a profit-taking phase. Any dip that we've seen in this market over the last 2 months has been 1 or 2 trading sessions, if that, and very shallow, as you can see by these red candlesticks, which are the down moves. And the market's been very strong otherwise. So that's where I see gold finding some support if we go into correction. And of course, it could continue to move higher pretty easily as well. With regard to silver, we hit 51.22 Thursday on that wild ride with a $3 price swing yesterday, and silver firmed up a bit today after testing higher again. But again, we've got support at 47.50, at 46.75, and then about 43.75. So I do think silver could see some profit taking and go into correction mode. If it got down to that middle green line, which would be possible on a corrective phase, that would put silver at about 45.75. It wouldn't break this uptrend by any way, shape, or form. So silver, I think in particular, is still very sensitive to supply and demand imbalances. We've seen the EFP in London, or the premium in London, go to $2.25 today, even higher than it was yesterday when the market blew out. And that bodes well for further silver price advances. And usually when we get these candlesticks to the top that are above the bar, that tells us where the market is headed. So I do think we're still going to see higher in silver, and perhaps sharply higher in silver. With regard to the gold to silver ratio, the silver price running a bit hotter than gold, with gold at 40.17 and silver at 50.05 on Friday afternoon today. We've got the ratio back under 82.5 to 1 for the first time in about a year. It's down to 80.25, and I still think we could see that narrow towards 75. As I said in the last couple of updates, it would put silver in the mid to high 50s now relative to gold, even if gold goes sideways. Platinum has continued to move higher. I do see support at 1550, where that major support line is. And now we're hitting resistance at 1700. We could go sideways and channel in the 1550 to 1650 range, still being a nice bull trend higher. And I do think that's probably what's going to happen. But with gold at $4,000 an ounce, platinum is a very in-demand metal for jewelry in Japan and China, and that can help to buoy the platinum price higher. With regard to palladium, we've seen palladium make a big move in the past week. It got as high as 1522 yesterday on that wild ride. We had a big correction lower today, but you can see the market went higher and lower, but pretty much held steady in about the middle of the range at around 1460. So palladium is looking a bit more vulnerable. I see support for palladium at 1300 and $60 an ounce, that little green line, and then again at 1300 if it gets that weak, which it may not. So that is today's update. Thank you so much for your time. We appreciate it, and thank you for your business. Without our clients, we wouldn't have a business, and there's never a day that goes by that we are not grateful for the loyalty and the trust that you've placed in us over the last 27 years. So it'll be interesting to see what happens on October 19th or thereabouts, if and when the Trump administration issues a firm clarification on whether silver will indeed be tariffed or not. And that'll make a big difference in what will happen with the silver price going into the rest of the year. So we'll keep an eye on that for you, and we'll get you updated on that in our next update. So thanks again.